A yield of over 6% is very attractive for a dividend champion. That's a company that's not only paid a dividend, but increased it for at least 25 years in a row. Imagine your boss giving you a raise 25 years in a row. It's amazing stuff. Today we're going to talk about a dividend champion that we're holding that has a yield now of over 6%. Now there's either value to be had here or a value trap. Which is it? Well, let's figure it out together. So I started with this simple chart from Schwab that shows dividend growth over time for any particular stock. And there's a couple of things to note here. So first of all, the table in the upper right shows the 5-year dividend average yield is around 4.5%. So it's upwards of 6% right now, which is abnormally high. It's a bit of a red flag. It usually signals that there's either value to be had or a value trap. And when you look at the growth rates here in this table, you see 10-year growth rate of 12%. That's great, right? That handily outpaces inflation. But look how that declines over time. So 5-year growth rate, 6%. 3-year, just 3.6%. So barely outpacing inflation. We're going to tell you why that is. But when we look at this chart, there's two problems here. First of all, the special dividend creates a scenario where you see the dividend growth increases sharply and then decreases. We don't include special dividends when we're looking at dividend growth for any particular dividend champion. So that's the first takeaway. Second, look how it says the dividend dropped 23% in 2023. And I was quite surprised to see that and immediately wanted to investigate because it's usually big news when a dividend champion stops increasing their dividend. And as you can see here, from this particular slide, which shows the company's priorities. You could pause and read that if you'd like, because we'll get back to that later. But they've increased their dividend every year since 1981. So that's a track record of 43 years they're quite proud of. So what happened? Well, when we go to NASDAQ to get the dividend data, you'll see a couple things here. First of all, notice how every year they increase the dividend by just a penny. So if they continue to do that, then growth of that dividend will continue to slow, right? So that's the first takeaway. Second, why is it in 2023 here, you see when they're paying 30 cents, there's only 3 payments instead of the usual 4? Well, it appears that there's something wrong with the financial data that most vendors are using. So we can go right to the source. And what they typically do is pay a certain amount for 3 quarters of the year, and on the 4th quarter, they increase the dividend by a penny. So you can see them doing that here in 2022. But when we look at 2023, you see there's only 3 payments here, and there's not that increase. So what we did is filed through their press releases and found that 4th dividend payment for 2023 is actually paid in 2024. So it's a bit confusing. And what it boils down to is that they still have that track record of paying a certain amount for the first 3 quarters and increasing by a penny in the 4th quarter. So takeaways so far, always validate the data yourself. Vendors don't always provide accurate data. So we spend thousands of dollars a year licensing data for our dividend growth strategy, Quantigence, for that reason. And there's still data problems that we need to work through. Ben or Franklin Templeton is a dividend champion with slowing dividend growth. The raises and patterns of their dividend payments are fairly predictable and intuitive, as we looked at. So let's look at how this asset manager makes money. So this monthly report from Franklin is quite interesting because it shows the assets under management that they have. And along the bottom, you see the total number. And they update that every month. And this is really their bread and butter. So the business model is to capture fees off the money that's being managed. So if you were able to capture, let's say 0.5%, that's over $8 billion in run rate. Well, they happen to tell us what they're capturing. And when we look at this slide here, this is from the last quarter, I believe, 77% of their revenues are fees from AUM, from all that money. So it's very important to monitor AUM as a key metric. The effective fee rate, so remember we talked about 0.5 percentage point? Well, it's just under that. And you can see here in the table there, effective fee rate along the bottom is slowly slipping over time. So how do you handle that? Well, you would increase your AUM to offset that declining fee rate. That's something that you want to pay attention to as things become more competitive in the asset management industry. But we definitely don't want to see AUM decline. And when we look at their revenues, you can see here from one quarter to the next along the bottom, they show, I love these charts, show the step change in various revenue streams. So investment management fees were up and adjusted performance fees down, shareholder servicing fees down, and then consequently you get the next revenue number, so you can see the changes there. Now, the latest monthly assets under management press release from Franklin Resources has something different. They're including now information about a company called Western Asset Management. You see here, it says, as of August 31st, 2024, Western Asset Management had AUM of $377 billion compared to roughly the same in the previous month. So they're watching that very closely. Why is that? Well, that particular entity, which is owned by Franklin Templeton, has run into some problems. So when we look at Western Asset, you see here a Franklin Templeton company. When they acquired Legg Mason, so Franklin Templeton, this was back in 2020, bought Legg Mason, essentially doubling their AUM. They inherited Western Asset as a result. And a couple of things to note here. So fixed income manager with $384 billion in AUM. So that hasn't changed that much from this point in time to, and this was before the problems they ran into, till today. So you're going to want to watch that very closely to see how that declines or potentially increases over time. They talk about 115 investment professionals, and the one that we're going to talk about today is the head of them all, and he is under investigation by the SEC. We'll talk about that. And they say here 100% of our portfolios are monitored by Wiser, our proprietary risk management system. Well, it didn't work so well if you're being scrutinized by the SEC, though Morningstar has commented on that, and we'll take a look at that. Now, when you look up the gentleman who's getting in a bit of trouble, along the bottom here, you see Ken Leach, the longtime Western Asset Management Chief Investment Officer, so the buck stops with him, left that role amid probes from the Justice Department and Securities and Exchange Commission, the SEC, into whether some clients were favored over others in allocating gains and losses from derivative trades. So that's a pretty formidable accusation, and it's funny here. Look at the Fixed Income Analyst Society. They used to have Ken's bio, and they quickly scrubbed that from their website. People in the investment industry do that all the time. You're great until you're not, right? Now, a piece by Morningstar looks at the outflows. Remember, since the CIO of Western Management, so they have $380 billion in AUM, and Franklin Templeton has about $1.6 trillion. So Western Management has a sizable amount of AUM compared to the total of Franklin Templeton. We want to watch and see whether or not that's going down. And here Morningstar shows us these numbers are declining as investors pull assets for any number of reasons. They've actually been on the decline over time. So you see here this more recent article from CityWire. It says, Ken Leach removed from all Western Asset Management sub-advised SEI funds. So they're undergoing parallel investigations by federal regulators in the Department of Justice. And what we need to see here is closure on this issue. There's no timeline that we're aware of. The company's likely going to announce when they think closure has been reached, but that could drag on for a long time. In the meantime, there's going to be a lot of noise. You see here, Franklin Templeton announces reorganization of WAM's total return ETF into WAM's bond ETF, and all kinds of things will happen. But this Morningstar article makes a couple comments here that I think are worth noting. They say they don't believe the firm's risk and trading process has failed, so that's good to know. They say that Leach's exit wasn't Western's only big personnel loss this year, so there's concerns before that, I suppose, and that these investigations of allocating U.S. Treasury derivatives across an undisclosed number of Western accounts managed by Leach. The investigation started in October of 2023. So a year ago? And then the SEC became involved a month after Franklin started investigating that internally. They say investors have been pulling money from Western's core and core plus strategies for nearly 3 years. So the decline isn't unexpected. Now, is this value or a value trap? That's the big question, right? Well, price of Ben's shares, it's depressed because of the ongoing investigation for sure. Growth for the company appears to be simply acquiring more assets to manage. And what are they inheriting when buying up these depressed asset managers like Putnam? That's a firm that they recently closed an acquisition on. You go look at the history of Putnam, and that doesn't look very good. It doesn't look very favorable. Now, what ifs aren't very helpful here, but what's the worst that can happen? Is it a fine? Would it be increasing outflows that accelerate over time? Long periods of time before there's closure? Is this a symptom of a much bigger problem at Western Asset Management? Now, we sell stocks in our dividend growth strategy for one reason only. That's if dividends fail to increase. And when we look at that situation for Franklin Templeton, the dividend appears in no danger. So this chart on the right shows their adjusted net income over time, earnings per share. And then what we can do is compare the earnings per share, the recent quarters, to the 32 cents with their coming raise that we would expect. Their next dividend payout should have a penny increase, as they always do. 32 cents a share dividend with the coming raise. It's easily covered by earnings per share, as you can see there. Now, earnings per share also increases when shares are bought back. Ben is doing this, so their most recent dividend announcement said they're buying back even more shares. Synergies from the acquisitions they're making should improve their margins over time, but they're growing by smaller and smaller amounts every year, the dividend, that is. So that's a concern. And the big question here is, does this company belong in the new money portfolio? So here at Analyze, we have a report. We have actually a couple reports worth noting. The first is Quantigence, our dividend growth strategy, and Ben happens to be one of the 30 dividend growth investing stocks that we're holding in our own DGI portfolio. And then we also have a new money report that has 10 tech stocks that we find most compelling and 10 dividend growth stocks we find most compelling. One happens to be Franklin Templeton. Now, I pulled up here the comments in the Quantigence report regarding Ben. And we have noted before that they were running into problems growing their business and the stock was sinking, and that's become less of a concern with Legg Mason. But we don't find them to be overly transparent when communicating their strategy to investors. And I think throughout this exercise, I've noted their investor relations sucks. Special dividends that they pay, those are going to remain excluded for the sake of simplicity going forward. I know that was mentioned. And when they acquired Legg Mason, they more than doubled their AUM at the time of that merger. Then they acquired Putnam, which has somewhat of a shady past. And the real concern I have here is their Q score that's been slowly declining over time. It's now in 5th place of 9. And when we chose Ben for our own portfolio, they had one of the highest Q scores in the financial sector. So this was taken from a piece we did on looking at TROW versus Ben, and this is where we started. You see the Q scores there on the right, so that provides us with an objective method to select dividend growth stocks. But there's been a couple changes. First of all, for asset managers, we simply zeroed out international sales because that's not really relevant. We used to do that based on AUM, whether it was US or ex-US, and we decided to just X that out. So you can subtract 2.7 from the Q scores for Ben and TROW. So those are two asset managers in our financials sector for the Quantigence strategy. There's actually 5 more names that aren't listed here. So their scores are roughly 15 each. And when you look at Ben today, it's actually under 13 because their dividend growth is slipping, as I said. So when comparing Ben to TROW, we chose Ben, I think, for one main reason, which was that they have a much more diversified set of assets under management. You can see that here on the left. Fixed income 35%, equity 32%. You see the breakdown between retail and institutional, and the U.S. at 72%. Then compare that on the right to TROW. You see 91% of their AUM is in U.S. and 52% equities. And they're having large outflows over time. We're going to talk more about that later. But the point is that we found Ben to be the more compelling of the two. Now, when we look at Q scores today, you see Ben's down there in the middle, 12.9, so just under 13. And when we selected Ben, we were leaning towards higher yields in asset management because if it's going to be a dividend stock, then it ought to have a decent yield associated with it. So this really brings up some questions, and I think concluding thoughts here. First of all, not overly impressed with Ben's investor relations. The first time I've really dug into it, and it just It's not that easy to navigate. The dividend payment data issue's really weird. I don't know what happened there, but the Q score drop due to dividend growth declining over time is a concern. I think when we see Q scores drop, it often predicates bigger problems. We need closure on the Western management problem, and it's hard to find a stock compelling when you have unknowns like that. What's the future of asset management? And I kind of raised that question in looking at all this data. Maybe a higher level take is needed here, so I think perhaps we'll do that. Maybe even look at TROW's strategy and what impediments they're facing and see if TROW wouldn't make more sense to hold instead of Ben. Now, do we replace Ben in our new money report? That's the big question a lot of subscribers have been asking. So we're going to look to provide some closure around that as soon as possible. So just talking about financial dividend growth stocks, I think this next piece is quite good. It has a lot of useful information. It looks at the selection process that we went through in order to choose Ben over the rest. Do give that a watch. Make sure to subscribe to our channel. Thanks so much for taking the time to watch this today.